So welcome to our Budget 2025 webinar and thank you for joining us. The format for today is that you're all muted, so any questions that you do have, please type those into the question box and we'll aim to address those at the end of the main topics of discussion. So after weeks and perhaps in some cases months of speculation and temperature checking in the run-up to the Budget 2025, perhaps this year's fiscal event will go down in history as the one with the premature release of the Office for Budget Responsibilities report an hour before the Chancellor actually stood up in Parliament. This is just a snapshot of some of the various predictions that have been discussed over the past few months. And here is an overview of those which have actually been announced in some guise or another. No doubt debates will continue as to whether the government has broken its promise not to increase income tax, national insurance or VAT, but we do now have a clearer picture of what tax changes are coming. I'm joined by my colleagues Dominic, Tessa and Jordan. Between us we cover all of the main tax regimes, so without further ado, let's get into the specifics of the announcements. First of all, rates and thresholds. Jordan, the big headline changes impact the thresholds and rates applicable for individuals. Can you tell us about those and who they'll impact?
Thanks, Gilly. It was announced that the personal income taxation rates and allowances, the freeze that was previously up until 2028, is being extended all the way to 2031. The OBR forecast suggests that this will raise revenues of 3.5 billion in 28-29, 8 billion in 29-30, and then 17.6 billion in 2030-31. Now, this is the highest forecast increase in tax take across all of the measures introduced by this Parliament. The second headline when discussing rate changes is the increase in the rate of income tax for investment-derived income. Now, within the build-up to the budget, there were many rumours of national insurance being charged on this type of income. So these new tax bands achieve a similar increase in tax take, just in a different guise. Very similar to when dividend tax rates were increased alongside national insurance back in April 2022. I suspect most of you have seen the new rates, but to recap, from April 26, a 2% income tax rate increase will apply to the basic and higher rate bands of dividend income, but not the additional rate. Then from April 27, the 2% increase will apply for all rates on saving and property income, and this includes the additional rate here. Unfortunately, the personal allowance are first offset against earned income, so we cannot tinker and beneficially allocate personal allowances against investment income. The Chancellor has retained the current personal savings starting rate and dividend allowances. However, those with significant investment income, such as investment portfolios, will see tax increases from this.
That's a lot to take on board. What's that actually going to look like in monetary terms for an individual?
So if we put this into a scenario for, say, an individual that we see within our client base, if we take a salary of 40,000, rental profits of 25,000, against which there's mortgage interest of, say, 10,000, and then savings interest of 5 and dividend income of 10,000 from a portfolio, say, in the current tax year, they'd have a liability of £16,438, but this will increase to £17,018 in the 27-28 years, an increase of £580, representing 3.5%, which obviously is much higher than the 2% marginally than the rates suggest. Whilst this £580 increase in the example doesn't seem huge, for landlords, this comes after years of negative taxation and legislative implications, such as mortgage interest restrictions, and now the Renters' Right Bill, which takes effect from May next year. The rental and property markets are ever changing, so we wonder what effects these changes will have on landlords and tenants alike. Especially in the world where the Renters' Rights Bill is giving tenants the ability to challenge excessive rent increases, which we might see as a result of this increased taxation. Time will tell, but just if we do start seeing property sales, just remember capital gains tax returns are due within 60 days of completion. These increases will not just affect those with investment portfolios and properties. There'll also be an impact on owner-managed businesses and remuneration planning. So, Dominic, what is this going to mean for those businesses?
Yes, I agree. There will be an impact on owner-managed businesses and how they extract profits from the business, whether that be by way of dividends or salary or bonus. Historically speaking, dividends were a more tax-efficient option for a number of years, considering the tax efficiency across both company and owner-manager. The lower dividend tax rates and the lack of national insurance contributions on dividends outweighed the value of the corporation tax deduction available to the company on the salary or bonus. Over more recent years, the scales have tipped somewhat in favour of salary or bonus, in particular the increase in the corporation tax rate to 25% and the increase in dividend tax rates have helped make that the situation in many cases. And the increases that you mentioned, Jordan, in relation to the basic rate and higher rate income tax on dividends will further reinforce this in those cases where the dividends would have fallen wholly or partly within those bands. Now, another important part of remuneration planning for businesses is benefits in kind and salary sacrifice. And I believe, Tessa, you have been taking note of the changes there.
I have, thank you, Dominic. So, like Dominic mentioned, salary sacrifice, as well as being a popular way to boost pension savings tax efficiently, has always been a key part of remuneration planning. So we've paid particular attention to the changes here. So the key change is that from April 2029, if an employee pays more than £2,000 a year into their pension via salary sacrifice, the excess is going to be subject to Class 1 NIC. So this is the NIC that's chargeable on both employees and employers. The rates at the moment are 15% on employers and 8% main rate for employees and 2% at the additional rate. So the measure, per the speech, seemed to be aimed at preventing large bonuses being diverted into a pension to avoid national insurance. But at a level of £2,000, the cap is going to hit a lot of people on a regular monthly pension contribution level. So the Chancellor's expectation was that these regular contributions would only affect 22% of people. Having spent some time with our payroll department yesterday, our numbers are looking more like it's 32%. So our numbers differ, I think, because of the level of salary, the level of contributions going into the scheme, and that could be because enhanced rates, i.e. above those for auto-enrolment, are being paid, or the qualifying earnings limits are being exceeded effectively. So I expect there to be more people impacted, but we will see. The good news is that this isn't happening until April 2029, so we've got some time to plan, but we've also got some time to see some changes in either this policy, or we've got some time to see some changes in government, which may mean we don't see a change at all. A point of note, and going back to what Jordan has talked about with the increase in rates, is that salary sacrifice is still going to be effective for tax. So with the increase in rates, it may still be effective to salary sacrifice, even with the increased national insurance burden for the employees. It will need careful modelling, because to save that tax, it will come potentially with an employer's NIC liability of 15%. So it would need to be looked at on a case-by-case basis.
Yeah, so thanks for adding that point there. As the tax trap and salary sacrifice is, an important planning measure that we can look at. However, as you say, we've got 2029 before these rules come into force, and probably some changes up to that point in time as well.
Yeah.
Thank you both. So moving on to investments then. What about people who hold investments or have built up valuable assets over time? Jordan?
So given the increase in the tax rates for investment derived income we've just discussed, it's even more important to ensure that these investments are held in the most efficient way. Despite rumours of reducing ISA input allowances, the Chancellor announced that the £20,000 annual limit will remain for everyone. For those over 65, this can be all cash or a combination of cash and shares. But for those under 65, 8,000 must be designated for investments in stocks and shares each year, with only 12,000 available for cash ISA investment. Now, the aim of this was to encourage investment for younger people in stocks and shares. However, from a quick look at Flagstone's December 24 stats, on average, those aged 65 and under have less than £39,000 in ISA accounts. So I'm not sure how this change is going to encourage higher levels of investing in stocks rather than shares, because there's no way of just encouraging investment anyway. So the other point to note, in her speech, the Chancellor was very positive about encouraging investments in startups in the UK. The money from which often comes from tax-efficient investment products known as enterprise investment scheme and venture capital trusts. However, within the released documentation that has been provided, there's been a bit of a hit for these incentives for investors in the income tax relief available for VCT, venture capital trust investments, will reduce to just 20% of the investment, down from the previous 30%. However, this 30% limit will still remain for EIS, Enterprise Investment Scheme investments. A point to note when we're always talking about investments is the importance of having a great financial advisor on your side to manage investments. Not only will they help manage investments, ensure that you're moving assets into ISAs efficiently, they can also work alongside tax advisors like ourselves to make sure the entirety of your sort of income is well planned for and structured tax efficiently.
Thanks, Jordan. So one of the most discussed changes from last year's budget concerned inheritance tax and the restriction of relief available for both agricultural and business property. Information on all of those changes and the impact on taxpayers is available on the Larking Gowen website. Jordan, have we got any updates on IHT? Has the government listened to any of the representations that's been made to it?
So yeah, partially they've listened, but as always, we've heard the headlines, and the devil is always in the details. Like with income tax allowances, inheritance tax allowances remain unchanged. The nil rate band of 325,000, residence nil rate band of 175,000 still stand, and the threshold for the tapering of that residence nil rate band remains at 2 million. So given the rising asset values we're seeing, more and more individuals will start to fall within the charge of inheritance tax. And especially see the effects of that £2 million tapering. On that point, we're seeing many of our clients moving into that. However, the published documentation suggests that the OBR only expect to see 130 million, of additional tax revenues by 2030. So in reference to the rising values of estates and properties, the Chancellor also announced the much rumoured mansion tax, set to be introduced from April 2028, which will see a council tax surcharge applied to properties valued over 2 million, that surcharge being £2,500 a year. Now, this will rise to £7,500 a year for properties over 5 million. Now, there is a sliding scale in between. We've not seen the detail on this yet. Questions are already starting to arise about how the properties will be valued. This is particularly relevant for our farming clients whose, say, farmhouses come with sort of significant land and curtilage. Questions are, to what extent will this curtilage be included within the valuation of these properties? It has been announced that the Valuation Office will be carrying out a targeted valuation exercise to identify the properties in scope, but they only expect fewer than 1% of properties to be within this over £2 million threshold. Documentation also notes that the revaluations will be carried out every 5 years. So the questions here are, will the additional council tax affect the market valuations of these high value properties? Or is this surcharge just going to become an accepted running cost of owning a high value home? time will see on that.
Okay, so did we have any good news for inheritance tax and estates?
We did. A very welcomed announcement was that the £1 million combined agricultural and business property relief allowances being introduced from April 26 will now be transferable between spouses. Now, the effect of this being that the complex will planning that we've been carrying out for the last 12 months has now been simplified to some extent, provided that assets are left to surviving spouses on the first death. Now, I will note that the released documentation suggests that for those whose spouses passed away before April 26 will receive the transferable allowance. Again, with this, the devil will be very much in the detail when we see the draft legislation, especially as to how the transferable allowance will be allocated, and also the interaction with the residence nil rate band and tapering. This interaction could mean it might still be beneficial to leave assets to non-spouses on the first death. Again, something that's probably going to have to be considered on a case-by-case basis. So whilst this eases the administrative burden of the new allowance, it is still being introduced and it is still set at £1 million. So it is still a call for arms for tax and succession planning with individuals, trusts and businesses. One final comment on the APR BPR allowance is that the £1 million was originally going to be frozen until 2030 and then uplifted index linked. This is now going to be frozen until 2031 in line with all of the other freezes that were announced.
Okay. So also in last year's budgets, there was an announcement made about changes to IHT on pensions. What do we know about that from yesterday?
So that's still going ahead as far as the documentation provided. There was a couple of small changes, which the biggest one is probably that personal representatives can now instruct pension administrators to hold back 50% of the value of the pension pot. Now, this can be used to settle IHT bills, interest and costs. So whilst we are awaiting draft legislation to confirm this, it would appear that the benefit is that the pension pot can be depleted disproportionately to the value of the tax due on it itself, reducing the value of the unused pot subject to the double tax when extracted by beneficiaries. Just as a reminder, that double tax was going to mean that we had an effective rate of up to 67% on the extraction of these unused pots by beneficiaries. So, you know, planning points surrounding utilising pensions still stand. Final point for me on inheritance tax, despite many rumours, the legislation surrounding lifetime gifting remains the same. So any planning that you couldn't get over the line before the budget still stands, and if there was a benefit to do it for the family, still go ahead with that.
Understood, thank you. So moving on to capital gains tax next then. We know that many people felt the need to divest themselves of their shareholdings ahead of yesterday's budget with the expectation that there'd be an increased tax charge heading their way. Did the worst predictions come to pass, Dominic?
No, they didn't. It wasn't as bad as we had feared. There was no general increase in capital gains tax rates. There was one particular measure in relation to employee ownership trusts, which is very significant. By way of background, EOTs were introduced back in 2014 and after a slow start had become increasingly popular as a means of passing on a business to employees in a tax efficient manner. Prior to the budget, qualifying sales that met the relevant conditions were exempt from capital gains tax, in practice a deferral of capital gains tax since the relief was held over against the trustee's base cost. The change is to exempt only 50% of the gain going forward. Capital gains tax will be payable on the remaining 50% and without access to business asset disposal relief. That is a big change. It's effective immediately. And it is surprising because significant changes were made in last year's budget following consultation, and they mostly tackled inappropriate use of EOTs. it seems that the government has noted the increased use of EOTs and therefore the increasing cost of the relief, and considers that what they are now doing strikes a sensible balance between encouragement for employee ownership and protecting the tax revenues. An important area, though it may sound a bit techy, is in relation to share-for-share exchanges and company reorganisations. This is where companies and groups are reorganised, for example, through the introduction of a new parent company in a group, or to create a group through the insertion of a parent company above a standalone company. And typically, this is done by way of a share-for-share exchange, which usually has the benefit of giving rise to no disposal of shares for CGT purposes. As all the best study manuals say, the new shares stand in the shoes of the old shares. Now, there is a process for obtaining HMRC agreement that the anti-avoidance legislation won't apply in any particular case through the clearance service, and this is really important because it provides certainty that shareholders who aren't receiving any cash from this transaction won't have a dry CGT liability. So the change which is being made is to the test that will be applied for these purposes, which prior to the budget was whether a transaction was being carried out for bona fide commercial reasons and not as part of arrangements for the avoidance of certain taxes. That is changing to arrangements that are to secure a tax advantage. So if the arrangements are to secure a tax advantage, those will be the circumstances when clearance won't be available and the rules will be invoked, anti-avoidance rules will be invoked. So how significant a change this is will only become apparent over time when we have experience of dealing with HMRC in respect of clearances under the new rules. But one particular area to consider is where we have companies who have recently obtained tax clearance but haven't executed the transaction, or where they are awaiting a tax clearance response from HMRC. And in those cases, it may be necessary to complete the transaction within a 60-day period in order to avoid having to potentially reapply for clearance under the new rules. Now, I talked about EOTs and the changes there. And one of the things that we often have to consider in conjunction with EOT implementation are EMI share schemes. And Tessa, you've been paying attention to the changes that have been announced in that area.
I have, thank you, Dominic. So we have some welcome changes in the EMI qualifying limits for a company, and I say welcome because these are coming at a time when companies are having to start to consider the value of the assets on their balance sheet, particularly in relation to leases. So one of the limits that is increasing is the gross assets limit, which is increasing from 30 million to 120 million, so quite significant. So hopefully is allaying those fears that we were starting to have. The employee limit is also increasing to 500 from 250. Again, very welcome, as sometimes that was bordering on prohibitive. And the value of unexercised options for the whole company is increasing to 6 million from 3 million. So these changes will apply to new options from the 6th of April 2026, but can also retrospectively apply to existing EMI options where they are unexercised. So the 10-year time limit is also going to be extended to 15 years from 10 years, and again, very welcome change.
So Tessa, what do you like about those changes?
So there's a lot to like. Like I say, we were starting to get concerned with the changes in the valuation of leases on balance sheet, that the gross assets test was going to become an issue. Hopefully that no longer is. And while we would always plan for an EMI to work successfully within the 10 years, sometimes for market reasons it doesn't. So the 15 years is a good change. for us. One thing that hasn't changed that I hope that would do in line with everything is the individual employee limit. That still has been maintained at £250,000.
Thanks, Tessa. So bringing it back to individuals, as Dominic said, the rate of capital gains tax stayed the same. So despite all the rumours, this could have been a lot worse. There's a couple of points to note. The first being that the Chancellor announced in her speech the closing of non-resident CGT loopholes. Upon a review of the policy papers published, this appears to relate to the definition of a property-rich company. These fall within the charges of non-resident CGT. The Chancellor estimates negligible impact of this through 2031, so it will just be something for probably investment brokers to consider when investing non-UK resident funds. An announcement was made regarding incorporation relief, which from April 26 requires a claim instead of applying automatically. Now, the draft documentation notes that claimants will be asked to provide a brief detail of the transaction, copies of tax computations, and details on the type of business being transferred. Now, typically, these details were provided for in white space notes of tax returns, so we expect minimal changes here on a reporting basis. The only point to note is where previously clients have relied on incorporation tax relief being available without collating information, they will now need to, so a bit more consideration on their behalf. The final thing that I wanted to note is the changes to business asset disposal relief announced in October 2024 are still going ahead. So the rate of capital gains tax for qualifying disposals will be increasing to 18% in line with normal capital gains tax rates from April 2026, with the 1 million lifetime limits allowance still applying.
Okay, thank you. So those are all the main headline changes, but in amongst those, I know that we've had a plethora of less prominent tax tweaks that impact taxpayers. So what else would you like to draw attendees' attention to, Dominic?
Yes, on the corporate tax front, it has to be said there's been relatively little change. Now, that is as expected because last year, you may remember, at the time of the budget, the Chancellor announced the corporate tax roadmap, which set out rules or set out the intention to maintain stability within the corporation tax regime. So what we have are some modest changes in relation to capital allowances and probably some expected changes predominantly affecting larger corporates and multinational entities. So taking the capital allowances first, as I say, these changes are quite modest, and it's helpful to remind ourselves of the beneficial allowances that are available in respect of capital expenditure. So the annual investment allowance provides for 100% relief in the first year on the first £1 million worth of qualifying expenditure, and that continues and is intended to be permanent. In addition to that, there's a full expensing allowance, which applies for companies, which also provides 100% first year relief against qualifying expenditure. That is uncapped, unlike the AIA, but applies to a more limited range of assets. So, for example, assets acquired to be leased don't qualify, nor do second-hand assets. So the changes announced in the budget really two changes. First of all, there's a new 40% first year allowance that's been announced. First, you have to think a little bit who that's actually going to benefit, given the 200% allowances in force. But this will be useful potentially for equipment lessors on expenditure which is in excess of the annual investment allowance, because they won't be able to claim super deduction on it because of the, super deduction full expensing allowance on it because of the restriction for leased assets. It may also be beneficial for unincorporated businesses who are over the annual investment allowance limit because they are unable to benefit from full expensing allowance. So some marginal benefits there potentially for certain companies. And another change, the writing down allowances that apply on a reducing balance basis where we have expenditure in capital allowance pools currently stand at 18% for main rate and 6% for special rate pools, and the main rate pool rate of writing down allowances coming down from 18% to 14%. So again, not a huge change. If I can move on to the other corporate tax changes, we have changes to certain aspects which are normally regarded as applying to larger corporates and multinationals, although in the right circumstances they may apply to other businesses as well. So transfer pricing, this covers the pricing of transactions for tax purposes where they're between connected companies. Permanent establishment rules, which determine the exposure of non-UK residents to UK tax, corporation tax, when they're trading in the UK, and the diverted profits tax, which addressed the diversion of UK profits and avoidance of establishing a UK presence. Now, there have been changes introduced following a number of consultations, most recently technical consultations launched in the spring, and the changes that are announced and confirmed in the budget papers are broadly in the same direction of travel as was anticipated in those documents. The highlight of these for many of our clients is in relation to transfer pricing, where there is now to be an exemption for UK to UK transactions, but that is with the caveat that only in the case where there is no UK tax at stake. So that's the highlight, but not groundbreaking change. We have changes to permanent establishment where the rules are going to be aligned more closely with current international norms, and the diverted profits tax will cease to operate as a standalone tax, and its essential provisions will be brought within mainstream corporation tax.
Lovely, thank you, Dominic. Tessa, anything else you'd like to add on the employer-employee basis?
Yeah, we've got quite a few changes that we've seen, but most of them are administrative or deferments of things that have already been released. So rather than focus on them today, we're going to talk about them in our employer bulletin that will go out towards the end of the tax year. The two few things I did want to mention, it's finally been recognised that how an expense is paid doesn't change the tax profile. So for instance, an eye test or a flu vaccine used to have to be paid directly by the employer to be a tax-free benefit. HMRC have recognised that just by the employee paying for it and having an expenses claim put in that's then paid by the employer doesn't change the tax profile. So from April next year, reimbursed expenses that would have been exempt, say the ones specifically mentioned, eye tests, flu vaccines and equipment for working from home, will be exempt, which is a brilliant change from an admin point of view. But on the theme of expenses and working from home, HMRC are no longer going to allow employees who have home working expenses that are not reimbursed by their employees to claim the £6 deduction directly from HMRC. So for an employee working from home, they would have been able to historically claim £6 directly from HMRC, or tax relief on £6 directly from HMRC. This won't be the case from April, and so if an employee wants to take benefit from that, they will have to talk to their employer about actually being paid that amount of money. The rest of the changes were mainly administrative. Lots of talk about CIS compliance tightening, particularly in relation to gross payment status and the tests that are going to be applied to PAYE compliance and VAT compliance. And on the note of VAT, Julie, we haven't really heard from you today. So any changes from you?
Happily not that many. So the VAT community was kind of braced for some really significant changes after last year's budget. On balance, we're probably absolutely delighted that we've been let off lightly. The registration threshold for VAT and the standard rate of VAT remain unchanged, which is great news. we've had confirmation from HMRC that they will allow VAT group registrations, which include establishments in EU member states, to treat supplies between the UK and that establishment in the EU as being an intra-VAT group supply with no VAT being applied to those. We've also had some clarity on the VAT treatment of taxis. So HMRC has now confirmed that from the 2nd of January 2026, operators cannot use the tour operators margin scheme, which some businesses were doing in order to reduce the amount of VAT that they had to account for. This brings some consistency across all the different business models operating in the taxi regime. However, they're now all going to have to charge VAT at 20% where they're within the VAT registration threshold, and that is inevitably going to lead to an increase in charges to customers, and that then brings some risks to those taxi operators' businesses actually continuing in the longer term. From a non-tax perspective, we've also now got a really clear deadline for the implementation of electronic invoicing to be mandated for business-to-business transactions. So from April 2029, it's going to be a requirement that all VAT invoices will be issued in a specified electronic format. We have a roadmap coming next year to tell us how that's going to be implemented. And at the risk then of sounding like Julie Andrews, in summary, can you each tell me your favourite thing from this budget? Tessa.
I think from the budget itself, from the policy documents, we've seen the EMI changes are going to make the most difference in my day-to-day work. But document also issued yesterday was the loan charge review, and that's going to have some really helpful provisions for taxpayers that are still working with HMRC to settle on loan charge cases.
Thank you. Jordan?
From my perspective, of course, the full details still haven't been released. The changes to allow the transfer of the agricultural and business property relief IST allowances between spouses is very welcomed for tax advisors, solicitors and clients alike. The shift brings the allowance in line with the nil rate bands and the transferability of those. And most importantly, it brings it in line with sort of the family dynamics of how assets are left. So yeah, that's the biggest win for me for this one.
Dominic, anything you'd like to highlight?
Well, I'm just relieved we didn't have to sing about our favourite things. From a corporate tax perspective, though, I think it's more by exception that as a result of the corporate tax roadmap, which the government has stuck to, we do still have some of the most positive aspects of the UK's corporation tax regime still in force. So that would be my highlight to pick out.
Lovely. And from me on the VAT side, we've got the new relief for businesses donating goods to charities. It's coming in from April 2026. And that's come about after a tremendous amount of lobbying and effort with HMRC, especially by the charity tax group. It's a great example of collaboration between HMRC and advisors to deliver real change for taxpayers. And hopefully that spirit of collaboration will be evident again in the upcoming consultation that's been announced on land that's earmarked for development for social housing. So that brings us to the end of what we wanted to talk to you about, but we'll now turn to the questions that you've raised for us to answer. So I think the first one, Jordan, is for you, if I may. Has there been anything about LLPs? Is this still going to be a good future partnership model?
Yes, so there was obviously a lot of rumours about changes to LLPs, none of which came about. So rates and allowances still stay the same. And given there was no changes on corporation tax side of thing, the comparison between the two is still there. Now, talking about LLPs, a lot of us tax advisors are LLPs. And one thing that was announced, which we haven't mentioned, is that now all tax advisors are going to have to register with HMRC. And this is going to be regulation, and it is a process to go through. So hopefully for potential clients of all tax advisors, this gives a bit of peace of mind that in order to provide tax advice, you have to be sort of a registered entity. So yeah, so from LLPs themselves, no real changes. for clients, engaging the services of an LLP or any tax advisor, there's some peace of mind there that we're all now going to be even tightly regulated.
Yeah, it's great, isn't it? Thank you. Tessa, I think this one's for you. We already have an EMI scheme with an EMI contract, which includes an exercise period of 10 years. Do we now need to cancel the existing contract and replace it in order to increase the exercise period? That's gone up to 15 years, I think you said.
It has, yes, and it's a really good question, because while the EMI limit was set at 10 years, most option contracts would include a 10-year long stop to stop options going beyond that date and accidentally falling foul of the tax limit. So based on the policy guidance, the answer to that is no. Because it can apply retrospectively, it's suggested that HMRC will allow you to amend a contract as long as it's within the 15 years and that not amount to a reissue of a new option. So you should be able to update contracts to the 15 years without it being a new EMI option effectively.
Great stuff. I think this one is probably for you, Dominic. I've read there that there are major changes coming for stamp taxes, but you didn't mention them. Can you clarify what's happening?
I can, yes. First and foremost, the changes announced are not in relation to stamp duty land tax on property. They relate to stamp taxes on shares. So at present, we have two stamp tax on shares. We have what private companies are probably used to, which is stamp duty on the transfer largely of private company shares. There's also something called stamp duty reserve tax, which is primarily there to tax transfers of listed company shares, which are done electronically. Now, probably for about a decade now, there has been talk of reforming these two taxes into a single digital harmonized tax regime, which does now appear to be on its way. The specific measure, which I've noted in the budget papers, was in relation to the provision or giving HMRC the authority to test a new digital service for this securities transfer charge, as they're referring to it. So it's a big thing in the sense that there are two taxes that we've had for a number of years which will no longer be with us, but they will be replaced by another tax which will be not dissimilar, albeit different rules. So I've managed to cover the abolition of three taxes today, but not in a way that is going to affect a huge number of our clients in a positive or negative way. There is actually another measure as well, which was in the budget, which was in relation to companies which list on the UK stock market. And that is to provide a relief from stamp duty on subsequent transfers of the shares in those companies for a 3-year period as part of trying to reinvigorate UK stock markets.
Lovely, thank you. Jordan, another one for you, I think. Is there a roadmap for the agricultural IHT? Our farm business is a partnership of brothers and children. No spouses are involved.
So there's not a formal roadmap, but the legislation is coming into effect from April 2026, whereby the £1 million allowance is a thing. It's coming into effect. What planning measures that your circumstances require is going to be a very much case by case as to the partnership. How do the profit shares look? What do the capital account look like? So it's definitely something that there's no golden bullet as to, okay, so you've got your farm business in a partnership, this is what's best to be done. I think it's speak with ourselves, speak with your own tax advisors if you've got them, about what steps work best for you as a family business.
Great. Okay, I think this one is probably one that I need to address. We already email out our invoices. Do we need to do anything else for electronic invoicing? Sadly, yes. If you cast your minds back to when Making Tax Digital came in for VAT, I think this mandated change to electronic invoicing is going to be at least on that level of disruption, if not more. What businesses are going to have to do is be able to transmit their invoices directly from their own accounting software to their customers' accounting software, and then effectively there'll be a way of categorizing the net and the VAT there. And apart from anything else, that removes the need to manually input purchase invoices, so potentially reduces errors, but it also gives HMRC the opportunity to really do data reviews on VAT treatments and therefore raise further inquiries if they think something has gone awry. Jordan, I think time, if we can, for just one more for you. It feels like HMRC have targeted landlords. Were any changes announced to making tax digital for income tax?
So obviously in respect to the landlords, as I mentioned, there's been a slew of sort of changes which are, tightening legislation, increasing taxation for landlords. In terms of making tax digital for income tax, that is still coming. April 2026, those with a combined turnover from self-employment and rental income of 50,000 are required to register and submit quarterly updates to HMRC. So, if you've not already spoken to your advisor, accountant about this, now is time is of the present. There's loads of different softwares involved that we can use to help you, meet your obligations. So get in touch with, sort of myself, one of your team, your accountant, and we can talk you through those options and what is required. But unfortunately, after many years of pushing it back, it is finally coming in.
Okay, thank you. So I think that brings us to the end of the question time that we've got available to us. But don't fear, if you still want to hear from Larking Gowen more in a little bit more detail, particularly on the business aspects of the budget, you've still got the opportunity to sign up for one of our autumn FD forums, either in Norfolk or Suffolk, taking place over the next fortnight. If that isn't for you, then we also have our series of autumn farming conferences taking place in the start of December over 4 locations. So take your pick and sign up for the most convenient for you. And finally, Dominic and I will be appearing again to talk about the budget in more detail. We will be recording a podcast and that will be available to you next week. Thank you so much for joining us. If you do need any more information from us, please feel free to make contact with us on that email address or telephone number.